Last time we covered the principles, 3 steps, and the 5 things that separate a good business from a poor one. That video was about what to look for. This one is about how to check it, because knowing that quality comes down to 5 things is still not something you can sit down and do on a Tuesday night. So we take those 5, open them into the 10 questions we actually ask, put a chart behind every one, and ask all 10 of 2 real companies. Microsoft and Kraft Heinz. Before any ratio, know what you are looking at, because a number means nothing until you know what produced it. Microsoft sells software and cloud computing to businesses, and its biggest block of revenue, around 40%, is server products and cloud services. Kraft Heinz sells packaged food, and its biggest block, around 45%, is sauces and condiments. One copies its product for almost nothing. The other buys tomatoes. And this is the whole income statement as one picture. Revenue comes in on the left. The costs peel off as it flows, making the thing research, sales and admin tax. What reaches the right-hand edge is what the owner gets, and some years nothing reaches it. Watch the first step, where each pays for what it sold. Microsoft gives up about 1/3 of its width. Kraft Heinz gives up about 2/3, because somebody has to buy the ingredients. Neither is a criticism. It is what the 2 businesses are. Start where we left off. 3 steps. Buy good companies, do not overpay, then do nothing. This video is the whole of step 1. And a good business, we said, comes down to 5 things you can see in the accounts. Growth that is real. Margins that hold. Returns above the cost of capital. Profit that becomes cash. And a balance sheet that survives a bad year. 5 things is the idea. 10 questions is the practice, because 2 of those 5 split in half the moment you check them. Growth is really 2 questions, one about the business and one about your share of it. A balance sheet is really 2, one about next month and one about next year. So the 5 open into 10. The last 2 are about what you pay and what comes back, so the first 8 are the business itself. One thing to hold on to before the first chart, because it is the same on all 10. You are looking at 2 things at once. The number itself, which we score against a fixed scale, the same scale for every company. And the direction it has traveled, which no single number can show you. A line that climbs for 10 years means something is working. One that swings or sits flat while the other climbs asks a question. The score tells you where a company stands. The chart tells you how it got there. Question 1. Is the business actually growing? Revenue, 10 years, and both companies start from the same line, so you are comparing the shape rather than the size. Microsoft's is a little over 3 times what it was. Kraft Heinz's ends below where it started. 10 years, and the top line went nowhere. Now the same question asked of profit, because growing sales while earning less is a different business entirely. Microsoft's net income grew about 5 times faster than its revenue, which is the shape you want, more profitable as it got bigger. Kraft Heinz went the other way, and twice in the decade its profit for the whole year came in below 0. We cover more than 3,000 companies. Of the 2,500 with at least $100 million of sales, just under half score 3 out of 5 or better on growth. So growth is not rare, and it is not the same thing as a good business, which is what question 2 is for. Graham gave the warning 70 years ago. Obvious prospects for physical growth in a business do not translate into obvious profits for investors. Question 2 is the same numbers divided by the share count, and that division is the point, because a company can grow and hand you none of it by issuing shares to pay for the growth. Look where these 2 start. Kraft Heinz begins higher, at $21.61 of sales behind every share, and ends at $21.01. Microsoft starts at $11.50, and ends at $37.90. One line crossed the other. And here it is on what each share actually has behind it in the accounts. Microsoft went from $9 to $46. Kraft Heinz went from $47 down to $35. The business did not shrink. Your claim on it did. This is the question people skip most often, because the headline number in the press release is almost never per share. Question 3. How much of each dollar of sales does the company keep? This is that flow picture from earlier, measured. Gross margin is what is left after paying for the thing you sold, and the gap here is enormous and completely unsurprising, Software keeps around 2/3 of every dollar, packaged food about 1/3. So the level mostly tells you the industry, not the company. Which is why the direction is the part worth watching. So here's the direction on what survives running the whole company. Microsoft's operating margin widened from 29% to 46%, which is a business getting more profitable as it grows. Kraft Heinz started at 21 and ended below 0, and the 2 years that plunge are the same 2 loss years from question 1. One company improved its own economics year after year. The other did not. 4 in 10 clear the margin bar, and that is across every industry at once. Which is the first hint that judging a margin on a fixed scale is not the whole story. It is a big enough problem that it has the next video to itself. Question 4 is about efficiency, and the clearest measure of it is not a quantity. It is a duration. A company pays a supplier, holds the thing, sells it, then waits to be paid. The days between the money going out and the money coming back are the cash conversion cycle. And every one of them is money somebody has to fund. Fewer is better, and it can go below 0, which means the customer pays before the supplier does. Question 4, measured. Microsoft started above 20 days and has fallen through 0. It now collects from its customers before it pays its suppliers, so its customers fund the business. Kraft Heinz spent its early years below 0 too, and ends at about 8 days. For a company that buys tomatoes, stores them and ships them, 8 days is a well-run cycle. Microsoft is ahead here too, but by the narrowest margin in the video so far, and a company can be poor at the questions that matter most and still be good at this one. If you only ever ask one of these 10 questions, ask this one. Question 5. Does the business earn a real return on the money tied up in it? This decides whether the growth was worth having, because 2 companies can grow at the same rate and end up somewhere completely different depending on what they earned on the money they put in. Microsoft has run in the 20s for the last 5 years. Kraft Heinz never got above about 5% in 10 years, and finished below 0. 402 companies, out of the 2,500 we measured. That is 1 in 6, and it makes this far and away the hardest of the 10 questions to pass. It is also the pillar we weight most heavily at 18%, for exactly that reason. Terry Smith calls it the primary test. As their earnings are generated with less capital, their return on capital employed is much higher than the average, which we regard as the primary test of their performance. Question 6. Does the profit turn into cash? Profit is an opinion formed under accounting rules. Cash is a fact. Microsoft's cash generation grew nearly 3-fold. Kraft Heinz's did not grow at all. It ends the decade below where it started. 1 year is negative, and in 2 more it fell to well under half. 10 years of cash going up and down around a flat line. Buffett puts the stakes plainly. Cash, though, is to a business as oxygen is to an individual. Never thought about when it is present, the only thing in mind when it is absent. Question 7 is the sleep at night one. Can the company cover what it owes over the next 12 months? And here is where the comparison stops being one-sided. Microsoft's cover has fallen by more than 1/3 over the decade, from over 2 down to about 1.3. Kraft Heinz ends at about 1.15. Microsoft is still ahead on the chart, but only just, and on our liquidity scores the 2 companies are level. Microsoft runs a deliberately lean balance sheet, and this is the question where that choice shows. That is why you ask all 10 instead of the ones that agree with you. Question 8. Is the debt safe if next year is a bad one? The test is how many times over the operating profit covers the interest bill. Microsoft covers it more than 50 times, so far up the chart that Kraft Heinz looks flat by comparison. It is not flat. It sits near the bottom, and in the 2 loss years it went below 0, which is a company not earning enough to pay its interest out of operations. Around half clear the debt question, and a little over half clear the liquidity one. Passing them is not a reason to buy anything. Failing them is a reason to stop. Peter Lynch reduced it to one line in his rules. Never invest in a company without understanding its finances. The biggest losses in stocks come from companies with poor balance sheets. 2 questions left, and neither is about whether the business is good. Question 9 is what you are being asked to pay, and that has 2 videos of its own later in this series. Question 10 is what comes back to you. Microsoft pays out about a quarter of what it earns. Kraft Heinz yields over 6%, and a yield that high is a reason to look closer rather than to celebrate, because a yield goes up when a price goes down. 10 questions, and every one was a chart you could have read yourself. That is why we left this until now. So here is exactly how the score is built. Each of the 10 questions is measured by 4 numbers, not 1. Margins. Question 3 uses gross margin, operating margin, EBITDA margin, and net margin together. Each of those 4 is scored from 1 to 5 against a fixed band, and the 4 are averaged into the score for that question. Then the 10 questions are weighted, because they do not matter equally. Returns on capital carries 18%, margin 16, cash flow 14, growth 12, and liquidity. The question these 2 tied on carries 3. Added up and Microsoft comes out at 3.94 out of 5, Kraft Heinz at 2.02. The bands themselves never move. A food company is scored against the same numbers as a software company, and that is a deliberate choice with a cost, which is what the next video is about. And almost nobody passes everything. Of the 2,500 companies we measured, 33 scored adequate or better on all 8 business quality questions at once. 33. A business that grows, keeps its margin, earns a high return, turns profit into cash, and carries safe debt all at the same time is genuinely rare. You are not looking for a perfect card. You are looking for strength where it matters, and a reason for every weakness. There is one thing those 10 charts cannot tell you on their own: whether the answer is normal. A margin that would be alarming in software is ordinary in food. Every bar we cleared today was a fixed one. The same for a software company and a food company. Ask the same 10 questions again, and rank each answer against the companies it actually competes with, and some of today's verdicts move. That is the next video, and it is the other half of this one. 10 questions, and here is what none of them can see. Whether the thing protecting those margins will still be there in 10 years. Whether the people running it stay careful. What a competitor is 2 years from launching. The numbers describe what has already happened. They are very good at stopping you making the obvious mistake, and they do not tell you what happens next. But they do hand you the right questions, and there are 2 places to take them. The first is the news. The charts told you Kraft Heinz's margin sat flat for a decade. They cannot tell you why. That is what the news is for. The numbers give you the question, the reporting gives you what was happening around it. The second is the one almost nobody does, and the one we would push you towards. Go back to the overview page and read the filing. Every number in this video came out of a document the company itself wrote and signed. We link the latest annual report, the latest quarterly, and the most recent current report straight to the source. So if a number surprised you, one click gets you the paragraph where they explain it. The reading is where conviction comes from. And this is where all of it lives. The quality page walks all 10 questions in the order we asked them, 1 panel each. Growth, then per share, then margins, then efficiency, then returns, and on down. Each panel carries the chart and the 4 numbers behind it. Every chart in this video came off this page. So there they are, all 10, in the order we asked them. That is the checklist. Screenshot it if it helps, because it is the same 10 every time for any company, in any industry. Templeton's own definition of quality makes the point better than we can. Quality is a company strongly entrenched as the sales leader in a growing market. Quality is a company that's the technological leader in a field that depends on technical innovation. Quality is a strong management team with a proven track record. 2 of those 3 are judgments. 3 steps, and we have now answered the first one on the company's own numbers. Buy good companies. In 10 questions you can ask of anything. But every bar we cleared was a fixed one. The same for a software company and a food company. Next in this series, the same 10 questions, asked again against the companies each of these businesses actually competes with, where some of today's answers move. This is general information about how to analyze a business. It is not investment advice, and Microsoft and Kraft Heinz appeared here as illustrations of a method, not as suggestions. Do your own research.